Have you ever wondered how peer-to-peer lending works? It's a fascinating model that flips the traditional concept of banking on its head. Instead of banks being the sole gatekeepers of loans, peer-to-peer lending enables individuals to lend money directly to each other. This creates a seamless financial exchange that bypasses the need for a traditional bank altogether. But don't be mistaken, banks haven't been completely sidelined. In fact, they often become majority shareholders in these peer-to-peer lending platforms. This intriguing blend of old and new financial practices is what makes peer-to-peer lending such a dynamic and exciting development in the financial world. Now that we've scratched the surface of peer-to-peer lending, let's dig a little deeper. Two platforms have emerged as leaders in this space, gaining significant traction since their birth in the mid-2000s. To understand this better, let's delve into two main platforms, Lending Club and Prosper. In 2006, the world saw the rise of two significant peer-to-peer lending platforms, Lending Club and Prosper. These two pioneers emerged with a fresh take on lending, offering a platform for individuals to lend money to each other without the need for traditional banks. Lending Club and Prosper have grown exponentially since their inception, earning the trust of millions of investors and borrowers alike. They've carved out a niche in the financial landscape, providing an alternative platform for loans that disrupts the traditional banking model. Each platform has its own set of guidelines for loans. Both Lending Club and Prosper offer a minimum loan amount of $1,000, with Lending Club capping the maximum loan at $40,000 and Prosper at $35,000. These platforms provide loan terms typically ranging from 3 to 5 years. Now let's talk about the annual percentage rates, or APR. The APR varies based on the borrower's creditworthiness, but typically ranges from around 6% to a steep 36%. This wide range can be daunting, but remember, higher returns often come with higher risks. Then there are the fees. Each platform charges a service fee, which is a percentage of each payment received by an investor. Lending Club charges 1%, while Prosper's service fee varies from 1% to 5%, depending on the loan grade. While these platforms have made lending more accessible, they have also introduced new considerations for investors. In traditional banking, risk is managed by the institution. In peer-to-peer lending, the responsibility falls on the investor. Now, what does this mean exactly? Well, when you're the one lending out your hard-earned money, you're the one who has to manage the risk. And one of the most effective ways to do this is through diversification. You see, diversification is not a new concept. It's a strategy that's been used by investors for centuries. The idea is simple: don't put all your eggs in one basket. In the context of peer-to-peer lending, this means spreading out your investments among multiple borrowers. Why is this important? Let's say you've invested all your money in one borrower and they default. You'd lose all your investment. But if you've invested in, say, 100 borrowers and one of them defaults, you'd only lose a small portion of your total investment. But diversification is not just about spreading out risk. It's also about opportunity. When you diversify, you open yourself up to a wider range of borrowers, each with their own unique financial profiles. This means you have the chance to earn higher returns on some of your investments, which can help offset any potential losses. However, it's important to remember that diversification doesn't eliminate risk entirely. It just makes it more manageable. You still need to do your due diligence and make informed decisions about who you're lending to. So, how do investors manage these risks and make informed decisions? The key to managing risk in peer-to-peer lending lies in understanding the credit rating of borrowers. This is a pivotal element in assessing the potential risk of default. Credit ratings provide a snapshot of a borrower's financial history and reliability. A high credit rating generally indicates a lower risk of default. On the other hand, a low credit rating might suggest a higher risk. However, it's not just about the borrower's credit rating. The platform you choose to invest through is equally significant. Well-established platforms like Lending Club and Prosper have built robust systems to assess borrower risk and provide clear, comprehensive information to lenders. They have a proven track record and are more likely to have measures in place to protect investors in case of borrower default. In addition to that, these renowned platforms also offer a range of tools and resources to help investors make informed decisions. They provide detailed borrower profiles, credit scores, loan amounts, and rates of return. This level of transparency allows investors to assess the risks and potential returns of each loan, thereby enabling them to make calculated investment decisions. Moreover, These platforms have strong customer support systems to assist investors, particularly in understanding the nuances of peer-to-peer lending and managing potential risks associated with it. They are committed to maintaining high standards of security, ensuring that your investments are well protected. In conclusion, effective risk management in peer-to-peer lending is a blend of understanding borrower credit ratings, choosing reliable platforms, and making well-informed investment decisions. Making informed decisions can help investors navigate the world of peer-to-peer lending. So, we've taken a deep dive into the world of peer-to-peer lending. This revolutionary financial model allows individuals to lend and borrow money from each other, eliminating the need for traditional banks. It's a financial landscape that's seen significant growth, with platforms like Lending Club and Prosper leading the charge since their inception in 2006. These platforms have democratized lending, giving people the power to invest in each other, but as with any investment, there's a level of risk involved. That's where the concept of diversification comes into play. By spreading out your investments among multiple borrowers, you can mitigate the impact of any potential defaults. It's about not putting all your eggs in one basket. Moreover, managing risk is paramount in peer-to-peer lending. It's crucial to consider the credit rating of borrowers and choose well-established platforms to minimize the risk of default. It's not just about lending, it's about lending wisely. In this exciting new world of peer-to-peer lending, knowledge truly is power. Understanding the landscape, recognizing the players, and being aware of the risks and rewards can help you navigate this space with confidence. Remember, informed decisions are your best tool in this new age of lending. Thank you for watching. To learn more about peer-to-peer lending, you can access a comprehensive guide at saveyourbucks.com. The link is in the description. If you enjoyed this content, we hope you will consider subscribing to this channel for more unique ways to make money and save money. We appreciate your feedback.